General risk disclosure. Trading financial instruments, including forex, futures, equities, commodities, and cryptocurrencies, involves significant risk of loss. Trading is not suitable for all investors, as it may result in the loss of your entire investment. Leverage, volatility, and liquidity risks are inherent in these markets. Before engaging in trading, carefully consider your financial situation, experience level, and risk tolerance. You should only invest money you can afford to lose. Forex and futures disclaimer. Trading in the forex and futures markets is highly speculative and carries a substantial risk of loss. The leverage nature of these instruments amplifies gains and losses, potentially leading to substantial financial exposure. This content complies with CFTC Rule 4.41. CFTC Rule 4.41 disclaimer. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Equities and commodities disclaimer. Equity and commodity trading involves risks associated with market volatility, company-specific factors, and geopolitical events. While stocks and commodities may have a lower leverage factor compared to forex or futures, they can still result in substantial financial losses. Cryptocurrency disclaimer. Cryptocurrencies are speculative and highly volatile instruments. Trading cryptocurrencies involves additional risks, including regulatory uncertainties, security vulnerabilities, and lack of liquidity. Cryptocurrencies are not regulated by most governments or central banks, and their value may be affected by external factors such as news events and market sentiment. Regulatory references. In the United States, this content adheres to the regulatory standards of the Commodity Futures Trading Commission, National Futures Association, and Securities and Exchange Commission. In the European Union, trading practices comply with the European Securities and Markets Authority standards. Global compliance, content aligns with internationally accepted guidelines, but laws vary by jurisdiction. Consult with a licensed professional in your area. Past performance disclaimer. Past performance is not indicative of future results. Any historical results or performance shown in this content are for informational purposes only and do not guarantee future performance. Educational content disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as investment advice, nor should it be construed as a recommendation to buy, sell, or hold any financial instrument. Always consult with a licensed financial advisor or regulatory authority in your jurisdiction before engaging in trading activities.
All right, let's do the chart work. Everything should be good. All right, this week, July 27th through the 31st, UJ, they should be doing yen intervention this week. But for us, we got FOMC on Wednesday, GDP and PCE Thursday. We still got to figure out what's going to be his preferred metric. We don't know if it's going to be PCE. Everything else is kind of lame. Wednesday maybe reversal because of Fed fund rate decision, and the market is actually nervous. He may hike. He's kind of been, I'm not going to tell you nothing. I'm working with task force, but they always do that. COT, commercials, 250 long, 270 short, or not, that's non-commercial. Commercial one, 1 million long, 1.4 short. Non-commercials taking profits on shorts. Also taking profits on long. Commercials adding to the longs. Non-reportables, they just going short. So expected behavior from this report alone, risk of consolidation and downside pressure, probably because all the shorts. Not a confirmed upside breakout. The downside break or fail rally will be fit for positioning rather than a sustained bullish launch. So fade the rally. Commercials are net short. Large specs are also net short, while small traders are heavily net long. This is not a clean bullish COT setup. This is commercial weakness because commercials are net short. Bias bears to cautious, especially if prices rallying into resistance or losing momentum. The opportunity will be stronger on a technical reversal or a failed breakout, not from the cut along. Then on the NASDAQ side, non-commercials, not really long, more on the short side, about even for commercials. Non-reportables are really long. It's not, if you notice the volume, like millions, 6 figures, nobody cares right here. Commercials are significantly more short than long, and they hold 56% of this open interest with just this amount. Okay. This mildly bears to neutral cut structure, not a strong signal. Commercials are only slight net short. Large specs are also net short, and the small non-reportable traders are net long. Immediate bias, cautious bears, but not aggressive. The better opportunity would be a failed rally, downside reversal pattern, or a weak seasonal window rather than shortened blindly. And here is the spreadsheet. I'm studying 13-week averages of non-commercials. So the traders are long in this. Long in gold too. And selling oil, which I don't know if this is going to turn around. What I did notice turn around was the Swiss. British pound looks interesting. I gotta do the dollar still. So let me go do that on my spreadsheet. Let's look at the Fed watch. Got 37% for a hike, but I'm thinking we'll stay. I think they kind of pricing that in with the war, and Kevin Walsh kind of talks a little hawkish sometimes. 37% chance of a hike. I think Fed Watch will win this round, and there'll be no change. I can see Kevin Walsh talking on task force, which is a nice way to dress up doing nothing. The Fed chair has been known as an office that says nothing with an abundance of nice words. Then we got earnings. It's really about Wednesday and Thursday. Microsoft, Meta, Apple, Amazon, but a lot of interesting things here for the stock guys. PayPal is doing some kind of deal. Boeing is interesting. Coca-Cola, UPS, Visa gives an insight on credit. Sophia, PG Healthcare, Fortinet. That's a good AI play. So it's a lot of interesting stuff. O'Reilly never fails. Yeah. Qualcomm's chips. See here. MasterCard, interesting. Valero, interesting because of oil, especially with the Middle East stuff going on. Rivian, good dudes. Robots was a big deal. Exxon, Chevron. So it's an interesting week besides just the NASDAQ focus Wednesday, Thursday. Great week here. We have Microsoft and Meta Wednesday, and Thursday we have Apple and Amazon. So go to sentiment. So now we're on 40s on the bear side. So notice the 40% swing. I've been noticing since we slide 40 back and forth. So since we slid bearish, we should have a bullish week. So last week was 40. We slid bearish. The time we was bearish, we slid bullish. So that 40 is the pendulum that swings. We in a market that's not really directional. NASDAQ now weeks, days. Just been selling off since here, creating these gaps as we go, clearing these wicks and using them as retracement levels. We just wicked this old volume and balance, so we'll see how we play here. Could be slow Monday, you never know. Anchor point interaction. So the anchor point is up here, June 15th. We haven't established it or disrespected it. We touched it and got knocked out. AI fatigue is what they calling it. They just like putting stuff with fatigue. Setup confidence plan is engaged. Here's the S&P. They actually finished the inside day. So a little bit stronger on this side. We ain't seeing the explosive rallies, but we do got earnings coming up, so we'll see. Here, same anchors over here, June 15th. Kind of just been chilling in ranges since then, enjoying the summer. Slight bit stronger here, but we are seeing a sell-off. Earnings story has been good so far. Banks did good, so tech is expected to follow. Confidence plan is engaged. Take a look at NVIDIA. Kind of boring over here, just been ranging, but we did respect that 200. And our anchors here, which is June the 2nd. Yeah, it's the 2nd of June. June starts here. 1, 2. The 200 saved the NVIDIA and bank stepped in. Skill focus is really stop hunt, base hit. It's not really a swing trading market. Journal intent more better. Case study hunt plan more better. Risk profile 1%. Week 5, we don't expect much until after the Fed fund rate. Planned strike day is Wednesday, since it's the Fed rate and big earnings. So we thinking Wednesday, midweek reversal. All right, that's that on that. Y'all have a good day. Peace.